Welcome to the AWA Market Minute, breaking down current economic, financial, and political events that impact today's retirees. Our investment committee performs hours of research and analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring investment advisors Jaron Monk, Mason Page, Chief Investment Officer Scott Hoxer, and your host, founder and CEO Paul Coles.
Welcome, everybody, to this month's edition of our AWA Market Minute. I'm Paul Coles, and with me, as always, is Scott Hoxer, our Chief Investment Officer. We're excited to have all of our clients join us today, and we're excited to, in a moment, introduce our guest today. He's back by popular demand once again. But just by way of housekeeping, as we do these calls every month, the information is designed to be educational, informational, entertainment. It's not designed to be one-on-one advice or specific in nature to any one of you on the call. So please reach out to us here at Alliance Wealth, and we can talk one-on-one about your specific situation, and don't take this advice and act on it without doing that first. About good, Scott, on housekeeping?
That's it. Well done.
Perfect. Well, very cool. One of my favorite kind of motivational speakers is a guy named Simon Sinek. Are you familiar with Simon Sinek?
I am, yeah.
And he shared a story about being hired to go to this Fortune 500 company and sit in on a board meeting, and this group had actually hired a consultant to come in and explain some analysis and due diligence the consulting firm had done on a project this Fortune 500 company was working on, and Simon Sinek was just kind of there as a guest. And the consultant was up at the presentation board and going through, and Simon Sinek finally just raised his hand and says, "Hey, can you stop real quick and explain that to me?" And there was kind of this like gasp in the room, like, I can't believe he stopped the consultant. The consultant kind of looked at him like, "Come on, man." And then he kind of explained it, and then Simon stopped him again and said, "Hold on, bring it back one level lower again." The consultant started going through it, and then Simon stopped and he said, "Explain it to me like you would your elementary school kids." And the consultant brought it way, way down. And after the meeting, Simon was a little bit worried that everybody in the boardroom was going to look at him and be like, "I can't believe, you wasted our time with asking these elementary juvenile questions." Rather than that happening, the CEO of the firm came to him and grabbed him and said, "Thank you so much. I had no idea what I was paying that guy to teach us. I didn't understand any of it." And him stopping and asking what he believed was the dumbest question in the room turned into a really educational opportunity for everybody involved. So as we do these market minutes, one of the consistent points of feedback that we get is keep it at our level, guys. We want to make sure we understand what's going on out there at our level. And it's really easy for us on this side of the desk who've been doing this for decades to unintentionally explain things in ways that aren't super helpful. So we've brought with us today a guest presenter who we just absolutely adore, and he is just loaded for bear. He's just got a ton of great information about what's going on out there in the market today. And one of the things that we appreciate about this guest is he does a great job of helping people understand the content. And if he doesn't, Scott and I are committed to stopping him and asking the dumbest questions in the room so that everybody gets a little extra feedback. So this is Kurt Brown. He's the Chief Investment Officer of a group called Townsquare Capital, and they're a multi-billion-dollar TAMP who has been recently acquired by one of the largest TAMP offerings in the entire country. Is that right, Kurt?
That's right.
So we're excited to have him on the call with us today. Scott, any color you want to add to Kurt's background?
I'll just say this. I've been in this industry 20 years. I've worked with Goldman Sachs, UBS, some of the largest names in the industry. And Kurt is as good as they get. His market acumen and knowledge and ability to share concepts is unparalleled. So super fortunate to have him today.
Yeah.
You guys are awesome, man. Thanks for the kind intro. I'm coming to you today from Idaho, so I'm up visiting clients in Idaho. So this is not my normal boardroom. So hopefully everything goes smooth.
Well, we appreciate you taking a minute out of your day to be with us and our clients, and it always is one that our clients come back with tremendous feedback and appreciate your time with them. There's a lot of burning questions out there, Kurt. A lot of questions on everyone's minds about, will there be a soft landing or an economic recession? What's going to happen with inflation, and will there be bank contagion? And I think one of the things that I get maybe regularly, in fact, this is our new office, and we had a client in the other day, and they were walking around. We were kind of showing them all the new office digs and taking them through some of the offices. And we came back to this room here where we're at, and we said, this is where we record the Market Minute and the podcast. And the client said, that's the place you sit and tell me to be patient. and I know it was tongue in cheek, but it kind of gets you a little bit like, is this just kind of getting long in the tooth? Are we just saying the same talking points and clients are going, just tell me something different, Yeah. And so to Kurt, what do we do from here?
Well, it's so interesting because normally when an economy is going into a recession, which of course just means that from the prior year, our economy is creating less output, right? That's all a recession is, it's just slowing growth, right? If normally it's because of more natural forces, but we're in a really different situation. And that's why this is such a tricky time, because there's a lot of pessimism right now, which I find really interesting, you guys, because the fundamentals have actually been so good. And the reason the Federal Reserve has been raising interest rates is to try to cool off the economy, right? When an economy gets running too good, that's what leads to inflation. That's what makes the cost of everything go up. So we're in a weird spot where we're cheering for the economy to slow down, but we don't want it to slow down too fast. So when you guys are listening to financial news, when you hear this soft landing or hard landing, what people are trying to figure out is, will the economy gradually slow down, gradually get rid of inflation, or is it going to come down hard where there's a lot of layoffs, a lot of bankruptcies and things like that? So we're in a really interesting spot because the economy actually is quite good, but we need it to cool off. So with that as a little bit of background, let's go through what we know. Okay, yeah. So where we're at is inflation is definitively slowing. I'm going to show you a couple things on that. Earnings of companies as a whole are slowing, but now it's not negative. It's just companies are basically making the same amount of money they made last year. So the earnings growth is flat, right? The economy itself is slowing down, but it's only slowing down some. So far, this is a soft landing. So far, we're getting things coming in the right direction because it's moderate. And people in my business, we spend all of our day kind of nerding out on investments and interest rate and things like that, are worried that the Fed might overdo it and tip us too much into a recession, right? So let's see where we're at, show you a couple things. This is really interesting. And by the way, I'm going to skip some slides because I carry around something that's akin to the Bible, and we don't need all that today. But I do want to show a couple of really important slides. So if you look at this, what you'll notice is this is inflation in the United States on a monthly basis. So right now, over a year, inflation is at 5%. But since the end of last June, look at the monthly. It's running at about 3% per year. So actually, since last June, we're actually back to normal. We're back at that 2 to 2.5% range. So that's really good. You can see here where it's happening, right? In the red and the green, the energy inflation and the goods inflation is going away, but we're still seeing some inflation there on the right in things like food and other types of services like airlines and whatnot. We're seeing something that happens a lot when you're going into a recession, and that's that ordering from manufacturers is slowing down. And historically, when we get under that red line, we've kind of been going into a recession. And you can see we're knocking on the door, right? We're just right there. And every piece of data we're looking at puts us kind of right in the middle right now. Inventories, that blue line, all that's showing you is that over the last 30 years, inventories like retailers in our country, how much stuff is in the back room. And there's a lot of stuff in the back room right now. And that bodes really well for inflation because it's hard for businesses to jack up their prices if they're holding a lot of inventory in the back room.
So Kurt, is it fair to say we've been hearing for a long time about, the supply chain disruption from post-pandemic and how that's caused a shortage in goods, which is ultimately, attributed to a lot of what at one point was referred to as transitory inflation. And the way you're seeing this now is we're actually rebuilt that stockpile again.
Yep. And honestly, about 97% of the data points show that supply chain problem is completely fixed. There's a few weird, quirky things out there. And by the way, this chart right here shows you that the supply chain is fixed. This is what it costs you to get one of those big metal boxes on a ship from China full of trinkets, right?
Yep.
And you can see it's down, 94, 95% from its high where we really had those supply chain problems. In fact, we're lower than we were now. It's cheaper to ship now than it was even before COVID.
Okay.
Lumber, here's another one that was really hard to get your hands on, but now we're back to where the same place we were 19 years ago in terms of lumber pricing, right? Even food and airline tickets are some of the most sticky points of inflation in our economy. The invasion of Ukraine was a real problem for food supply for obvious reasons, right? With all the wheat from that region. But we're seeing food prices down at like a 2-year low. Now, you and I are not seeing it at the grocery store yet. That's the last place that we see the savings. But where we are starting to see it is in places like this. The red line are fertilizer prices. So we're a lot of the stuff that we want to see is coming the right direction, and pretty soon we should start to see some price easing at the grocery store. The labor market, right? We've talked about this ad nauseum since COVID. Red hot, right? Here's all the monthly and quarterly additions to jobs in this country. But this is interesting. This is data from just this past week here, is that if you look at what companies are doing with their workforce, the blue bar is companies laying off people because demand is slowing. They don't need as many workers. The orange bars are just because they're laying off people because they're saving money. Well, look at what's happening. We're finally seeing a change where more businesses are actually starting to lay off because the economy is slowing. So we're starting to see, by the way, this is probably a good thing. Nobody wants to have people laid off, but if we look at the whole economy, it's actually a pretty good thing that we're getting things kind of back to normal because we went through this really insane post-COVID period.
Is it fair to say that, when a business is cutting jobs as cost cutting, that's more reflective of management and earnings of a business, whereas if a business is cutting jobs because of demand downturn, that's more reflective of a cooling economy?
That's right. And specifically, not only is that right, Paul, specifically in this cycle, firms overhired. In fact, I have a slide. Let me just jump to it because we're talking about it here, right here. Okay. What happened coming out of COVID, you've heard about all these layoffs with Google and Microsoft and Facebook and people like that. What happened with coming out of COVID, the economy exploded in a way that nobody anticipated. We over liquefied the economy. There was too much stimulus, right? Well, Amazon, for example, couldn't keep up with their hiring, Google and Microsoft. So they overhired. So look at some of these numbers on the left. Amazon doubled their workforce in 3 years. From 2019 to 2022, they doubled their workforce to 1.5 million people. So they've announced some layoffs, but it's almost like a rounding error. Yeah. So what we're seeing right now is a lot of like re-optimizing the workforce because there was a panic to hire people. So a lot of the layoffs that you're hearing about right now are just fine-tuning what everybody did coming out of COVID. You're exactly right.
Yeah. Kurt, and to maybe add to that point, I think people hear the word recession and it elicits a lot of like terror and fear. And, I think we forget sometimes there's just this natural business cycle where we have periods of boom and periods of bust. And in a lot of ways, there's something beneficial is too strong, but with recessions, you clear out a lot of the dead wood. I'd compare it to almost like a controlled burn in a forest where, hey, let's get some of the tinder out of there so that we don't have a big conflagration at a later point. Is that kind of how you view it as well?
That is 100% correct. And it's hard to talk about that, Scott, because of the lives that are impacted in a recession. And for the lowest income earners in our country, recessions hit them exceptionally hard.
Yeah.
But you're right. In the long run, it's healthy for an economy because there are a lot of businesses that probably need to go bankrupt because they've been so badly run that, too much money has been borrowed. They're not selling enough goods and things like that. And you're right. It's very much like a controlled burn. It's a great analogy. One thing that's happening, and you can see where most people in our business that invest for a living kind of are not buying what the Federal Reserve is selling. The Federal Reserve right here is still saying we're probably going to have to do a lot more raising of interest rates. But the people that invest in bonds for a living are betting with their money that 2 years from now, interest rates will be at least 2% lower than they are today. The market is actually pricing in a lot of rate cuts over the next 2 years. Not so much because people are betting that the economy is going to be so bad that we have to cut rates. It's that we've had to artificially lift interest rates to curb inflation. And most people that buy bonds for a living are saying, we've done the job. Inflation is almost for sure under control. And so you can see what's happening in the bond futures market, which is a fancy way of saying that you can go out in the future and invest what you think interest rates are going to be. And yeah, go ahead.
Well, I was going to say, let me give maybe some color to that, just in the interest of like my Simon Sinek analogy. When people go and try to guess outcomes of sporting events, they have really great analysis that they can look at, research, statistics, and some of the top people out there have outcomes percentage they believe will happen. The number one most accurate source for placing bets on sporting outcomes is actually Las Vegas, which I think is super ironic, right? Because what you have there are people that are actually placing their money where their mouth is. And so when we talk about Fed futures, it's actually people that are saying, I'm going to buy an option against what I think is going to happen with the Fed's futures. It's actually a very accurate predictor of what we see that's going to happen, because these are people that are actually putting their money where their mouth is, saying, I want to make money on this outcome. And so it's a pretty accurate predictor. And I think by all accounts, we're seeing that turn, end of this year, beginning of next?
You know what's interesting too, Paul, about that, and I don't want to get on a tangent here, but like these same people, if you ask them a survey question, this survey is different than what they're doing with their money.
Yeah.
The verbal survey is interest rates are going to stay higher. But what bond traders are doing with their money is saying, no, interest rates are going lower. So it's really an interesting market for this right now.
Yeah.
A lot of the fundamentals, and I'm going to skip through this quick, but a lot of the fundamentals are telling us two different stories. It's telling us that that the fundamentals of the economy have actually been exceptional, but there are things happening that could be recessionary. We could be tipping into a relatively mild recession. And I'll just go through these quick. Banks, for example, are tightening how easy they loan money. And that got a little worse with this recent thing with Silicon Valley Bank. And we'll talk about that in a second. That chart just simply shows the same thing in another way. Profit margins were at 70-year highs until recently, but because the cost of materials have gone up so much in 2 years, profit margins are down. So you're going to hear, profit margins are lower, but you can see they're only a little bit lower. We're still right near what the all-time highs in profit margins have been. This is a chart that just shows daily travelers. We're even higher right now than in 2019. So as a barometer of the economy, travel is usually a pretty good indicator. I'm going to skip that one. That right there will show you that black line is profits of the S&P 500 companies. Look at how hot they were coming out of COVID. It's just not sustainable. So we absolutely are sort of due for some cooling there. These next couple slides are super important, but what they're showing is that while the government has been a very big borrower, right? They've taken out a lot of debt, the government, but the private sector has not. This is corporations in this country are working on a 60-year low in terms of the amount of debt they have compared to what they make. I'm going to skip over that one. This is what the average small business has in their checking account. It has continued to go up. Even since the stimulus programs ended post-COVID, the average small business has stockpiled a lot of cash. Again, that's a healthy sign, not a sign of debt. This is the households. And I don't want to spend a lot of time on this because we've talked about it in the past, but the households are borrowing a little bit more the last several months, but not a lot when you look at the historical context, okay? So we're not at the lows that we were at last year, early last year. So there is a little bit more borrowing taking place, but just not much so far. This slide shows how much dry powder Americans have, how much they could borrow. The top is the amount of home equity that you and I could draw out. We are utilizing very, very little of our home equity right now compared to historical standards. It's almost always been around 50%. We're at 38%. So a lot of us could tap home equity if we needed to.
And this is probably another good kind of reference point because we hear regularly people will say things like, well, this is like 2008 all over again.
No.
And these numbers couldn't have any more stark a story to tell than what we saw in 2008.
Yeah. And honestly, the bottom of the chart got cut off there. I apologize. But the top that you see right next to the gray section is 2008. And I'm going to show you some other slides here. We are in such a different place than 2008. In fact, the set of problems is 100% opposite of what they were then.
Yeah.
We've talked about this in the past. I won't spend a lot of time on it, but banks have been stockpiling cash. Forget about Silicon Valley Bank for just a second. I'll revisit that in a moment. But when you look at the major banks in this country, they are sitting on insane levels of cash. They're just not lending it out. It's basically a 70-year low now in how much they're lending out compared to what they have in the bank. And you can see on the left, that's Bank of America's average FICO score of their borrowers. Okay, that's incredible. In 08, those scores were 150 points lower. I mean, the banks were lending to subprime like there was no tomorrow. We have the opposite problem now. I mean, the banks will only lend if you don't need the money at all. I mean, is sort of the current situation. Okay, commercial real estate. Okay, here's all I'm really going to say about this is that yes, it's a problem. Number one. However, the mortgage market is so massively different than the 1989-1990 disaster that was commercial real estate. I mean, significantly less. And by the way, it's also better than the 08 crisis because there are several parts of the real estate commercial market that are red hot and super strong. A real lack of supply. Remember, 08, we didn't have a lack of supply. We overbuilt everything. So yes, we are having problems in office space inside the city and office space suburban because there's more work from home. But every other category, multifamily, apartments, even retail's a little bit better, and it's certainly industrial. We still have a supply problem. We don't have enough. So we are going to have some problems with commercial real estate debt, but it's a highly anticipated, everybody knows it's coming, and most investors in those types of bonds have already started to write down those losses several quarters ago. And that's why you're not seeing a lot of people worry about it too much, because yes, places like San Francisco and Chicago are having serious problems for obvious reasons. But it's probably not the kind of thing that will lead to anything systemic. It's not like 08 where dominoes start toppling and banks start falling, right?
And let me maybe touch on that too, Kurt, because I think the notion, maybe just the concept, you touched on it at the application for the bond market here, but I think the concept of people pricing in these potential problems in advance of the problem, I think sometimes that gets lost on the average client or the average consumer. The notion that we see what the problems are. I guess what I want to say here is sometimes people say, oh, we're being tone deaf, we're not reacting to the potential concerns we see. But the market did that. The market reacted, it priced that in.
That's right. In fact, I'm glad you stopped that. Let me explain how this actually works, because we just heard in the last week, from Wells Fargo and JP Morgan. Wells Fargo and JP Morgan reported earnings, and the earnings were good. And especially in light of what happened at Silicon Valley Bank and Signature Bank of New York. Okay, so we finally got to hear from them. Okay, so here's what they did. And this is what smart investors do, right? Is they are going to have some loans go bad. Well, they already know that. Even though the loans haven't gone bad yet, they're anticipating what's going to happen. So both JP Morgan and Wells Fargo took massive losses now before the losses even happen. In other words, they go in the books and say, that loan we're going to actually mark at 20 cents on the dollar or zero, and we're going to actually eat it now. So in other words, if it doesn't end up being as bad, it'll add to profits.
Boost
later.
profits.
Yeah, that's exactly right. And we've been seeing this for a couple of years since COVID. Big banks and hedge funds writing down a lot of these loans because they know that a lot of this office space is going to stay vacant for a while. Yeah. And so they want to be prepared in advance. And by the way, this was one of the good things that came out of 2008 is that the US Treasury mandated that banks do this type of preparatory behavior in advance.
Yeah, we're not going to pop the bubble. We're going to deflate the bubble.
That's right. Over time.
Over time.
That's exactly right. Yep. Okay, look, I want to touch on the Silicon Valley Bank thing real quick because it's super important, and I know it has a lot of people worried. Okay, in a 2-week window of time, and by the way, it's actually, I put 600 billion here. It actually ended up being about 900 billion. Okay, so in 2 weeks, we saw 900 billion moved out of regular checking and savings accounts in this country. Okay, where did it go? Okay, this right here is the problem. Okay, and everybody knows this because everyone on this call knows that you keep cash at your bank and they give you nothing for it. So at the bottom of the chart, you see the yellow and blue lines. They're almost at zero still. But the green line is what interest rates are doing. So you and me are getting frustrated with our bank because we know that the banks are getting paid on government bonds a lot of money, 4 or 5% or more. But they're not giving us the interest in our checking accounts. And so what's happening is investors are starting to move that cash around, get a custom bond portfolio, move it into a government money market account or something like that. Well, here's the problem. When this happens, the good thing is there's a lot of cash in the system. There is an incredible amount of cash in the system. It's why most people are not worried about some systemic problem right here. So that's the good news. The bad news is which banks is that going to end up coming back to haunt? So I want to show everybody something here. Okay, I know this is a lot of data and a lot of numbers, but it's pretty simple. The chart on the left goes back 30 years, and it shows how much extra money banks are keeping on hand. And you can see in the early 90s, and then again, look what happened in 2008. The banks started keeping less and less money on hand. And we all know what happened in 2008. Well, that is massively different than it used to be. We are still sitting right near the all-time highs of how much extra cash banks are just keeping for a rainy day. Okay, so then what happens is we find out with Silicon Valley Bank that there's this weird rule that the Treasury says that banks don't have to mark their bonds to market. All that means is this: a bank buys $100 billion in bonds, but the bonds today are only worth $80 billion. They can still show that the bonds are worth $100 billion because they're probably going to hold those bonds forever. Okay, the chart on the right is the important chart. It does to every major bank what happened to Silicon Valley Bank. In other words, it shows you and me, if we took those banks, JP Morgan's the first one on the left there, and we made JP Morgan sell all the bonds that they own at today's market prices, what does it look like? Okay, well, look at the third one from the left, Silicon Valley Bank. Okay, part of this was because Silicon Valley Bank did not insure any of the bonds they own. We call it hedging. So Silicon Valley Bank just said, we're just going to let the bonds do whatever the bonds do. Silicon Valley Bank has this really unique client base. And when it got out that their bonds were worth way less than people knew, there was a run on the bank. And there was a day where $40 billion was taken out of Silicon Valley Bank, and they only had $120 billion in liabilities. So a third of the bank was pulled out in one day, right? But look at the rest of the banks. They're in a radically different position than what Silicon Valley Bank was at the end of the year. You can see the date there is Q4 22, right? Silicon Valley Bank, a lot of people in the industry kind of knew they had this problem, but didn't anticipate that there would be a run on the bank in a good old-fashioned style, and there was. But Paul and Scott, I really just wanted to show this because Silicon Valley Bank and Signature Bank of New York are really, really different animals. They were in a really different spot than most banks are.
And my sense with this the issues we've seen with the banks over the last month, Kurt, is this is one of those items in the market where it's intense and short-lived, and we kind of move on. And it feels like for every COVID-19 or '08 financial crisis or really severe market downturn, there's 100 items like the flash crash and other items where you almost forget about them. Would you kind of put that in that bucket, or is that understating how severe the risk is?
That's actually a great question. This was an event. I don't want to downplay it because when you start talking about bank runs in this country, you are talking about a serious problem. We remember that from '08. There's nobody on this call that doesn't remember what that fall of '08 was like. But here's the reality. The U.S. government has a lot of problems, but they get some things right. And they have learned in time that they must ensure the deposits that you and I put at U.S. banks. So there is a new playbook that they didn't use in '08 that they used this time, and it worked so well. In other words, all of the Silicon Valley Bank stock and bond holders will be wiped out, which they should be. Poorly run bank, clearly, but the depositors will be made whole. And that's what you're going to see is the new playbook here. And that's why the market has taken a lot of comfort in the fact that even if a bank does something dumb, you're going to have the deposits insured. And they
it stops contagion.
That's right. That's right. And ends up saving the government a ton of money in the long run.
Right.
If they'll just insure that one bank's deposits. Look how quickly it stopped the bank run.
Right.
It worked. And they worked through the weekend, and by Sunday night we had an answer, and by Monday morning the world was back to normal.
And it's not like the banking system is new, right? I mean, that's one of the oldest financial institutions in the world is the banking system. So it's not like we've never experienced, what it means to put your money on deposit and then 90% of that money gets lent out back into circulation. And then everybody says, well, it's only based on the fact that if the system works, they can go back and get their money.
That's right.
And so the government gets this, and this isn't a new system. It's been operating for a couple of years. So Kurt, we're right at the 30-minute mark. We're trying to honor our clients' commitment, but I do want to just maybe end with a rapid fire, kind of town hall. And Scott, I'd like you to weigh in on these too. Whenever I get a text from my sister, who gets involved in investments and finance about once every blue moon, then I know it's reached the masses, right? So that's when I know it's reached the masses. So fact or fiction? You guys just rapid fire here. Fact or fiction? I need to go and get my money out of the banks.
Fiction.
Totally fiction.
And why? Give me some why there.
Because of what we just said. The deposits are going to be fine. You may need to end up moving them. And if you are at a weak bank, you may want to move them anyways, but your deposits are going to be just fine. The government cannot have bank deposits get vaporized. You can't.
Okay. Fact or fiction? I need to get all my money and put it into gold.
Fiction.
Fiction.
And I can take a stab at this, Paul. So, and this plays well into everything I think we've talked about. And I've noticed this over the past kind of from COVID till now is it feels like there's a big disconnect between kind of the stuff on social media and in popular press and then the economic reality that's occurring. And I think, if you read popular press and social media, you get this notion that the fundamental economy and capital markets are in a totally different place. And, there's no shortage of apocalyptic predictions. But from my standpoint, capital markets are going to do what they've always done. Companies are going to try their darndest to make money, and if you own quality companies, you are going to grow with them over time. Whereas, gold is going to be, do what gold does. It's going to have periods of boom, periods of bust, and gold doesn't pay any dividends. Gold doesn't make any earnings. It's going to be a hedge in a crisis, and, certainly not a wise strategy to put all your eggs in that basket.
And Scott and Paul, this is really an important point. Gold doesn't create anything. There's no leverage to gold. You can't even eat it, right? So this right here on your screen, to Scott's point, U.S. corporations are always greedy and trying to make more and more money all the time. So you go back 70 years, both the S&P 500 earnings and the S&P 500 stock prices are both up over 8,000%. You literally are buying the future streams of income from these companies. And you can't tell me that some company like Apple is going to say, you know what, we're done growing and we don't want to make any more money because of X, Y, and Z.
Right. Well, I think those are some of the big things that we regularly hear from people is, now's the time. I mean, maybe this is my last fact or fiction here. Is now the time, after having been invested for the last 2-3 years in a long-term investment financial portfolio, is now the time to finally make overhaul the portfolio, wholesale changes, fact or fiction?
What do you think, Scott?
I think a qualified fiction is kind of how I would state that. If you have fundamental issues with your portfolio, it's never a bad idea to make some adjustments. But no, this is, if you're talking about, hey, I'm gonna, put my money under a mattress and, call it quits with capital markets, that is a terrible idea in my opinion.
Yeah, I totally agree. And I'm with Scott. There actually are times to continue to tweak and evolve and change and rebalance portfolios. And there's things you might be missing. You might be too aggressive, too conservative, things like that. It's an organic process. But there is nothing different about what's happening right now than it's happened in any decade. There's always great things happen in the economy, some bad things, right? And you want to focus and control what you can control. And how we build the portfolio. And by the way, the advisors on our team your team are very good with this. Like, building a portfolio is built to have rocky, rough periods of time if it's done properly.
Well, and that's probably a good place to maybe transition to an ending is if the destination has changed, then we need to address the map and the compass. But if the destination is the same, then we need to continue to work towards what are our next steps in that journey, going towards that same destination, and not throwing away the map of the compass and running back to the car. So, Kurt, we really appreciate you taking the 30 minutes of being on this call with our clients today. I know everyone always just appreciates your energy, your insight, and just your ability to kind of communicate these complex topics in a way that people care about and understand. It gives a lot of peace.
I love this. I get to hang out with you guys more when you invite me. So anytime.
Well, listen, we'll do it again soon. Scott, any parting comments?
That's it. Yeah.
Well, we sure appreciate all of our clients being on the call with us today, and look forward to working with you guys. If there's any, to Scott's maybe final point, if there's any adjustments or life events that have occurred that do necessitate adjusting the planning, those things need to take place, and you need to reach out to your team here at Alliance Wealth Advisors. That's what we're here for, and we will make those adjustments on the margins and make those tweaks so that you guys are in the best possible position to succeed in today's capital markets and given today's current political and economic climate. So until we have that call, we appreciate you guys all. Take care.